Please welcome our Fireside Chat, a discussion of business and politics with Ivan Kaufman and Scott Rechler.
Okay, good morning, everybody. Good morning. So, first of all, it's good to be back here again and see everybody, and clearly the circumstances continue to change in this industry and in life and, politically and for who we are and what we're experiencing. But it's really my pleasure to have with us today Scott Rechler. Everybody knows Scott. He's CEO and chairman of RXR. They manage over $22 billion of assets, a lot of office. They do have a lot of focus on multifamily and development. And very significantly, as you know, Scott is also on the board of the Federal Reserve of New York, which I'm sure everybody's going to be interested in his point of view and their point of view, and the economy, interest rates, and what the outlook is. Scott is no stranger to serving on very significant institutions. He was chair of the Port Authority of New York. He was also on the board of the MTA, and he's involved in just a tremendous number of institutions, whether it be universities, museums, and hospitals. He's also extremely involved in the political scene around New York, and he knows probably more about New York than most people I've ever met. And he's experienced New York in many different ways, from many different perspectives. So I think we're very, very fortunate to have somebody who not only knows our industry, knows finance, but in this kind of environment could really shed some light in terms of how all these geopolitical issues really are affecting us psychologically and cyclically. It's quite interesting because Scott and I met, I think it was 1990, 1991. I would say I was in my early 30s, you were in your late 20s.
Early 20s.
Early 20s. Okay, I was in my late 20s, you were in your early 20s, something like that. And I think we were both starting out for the most part. And we had met, and it was a very fascinating meeting because, like today, it was a dislocated cycle. And Scott was just beginning his career, or at least it seemed that way, but he had a big voice in a very complicated transaction. And I was looking to lease a building that their family owned, and it was a tremendous dislocation in the market, and the building was somewhat vacant, and I was taking a couple of floors, and I kind of knew I was important to his restructure, even though he didn't tell me that. And miraculously, after they got me to sign for 2 floors, he pulled a rabbit out of a hat and restructured that deal and it was, by the way, the best building in Long Island. I think still continues to be the best building. But that was a cornerstone for him to really rise, know how to restructure, take control of an asset in a very dislocated period of time, which is kind of where we are today in a very dislocated period of time. And I think it's going to be interesting because Scott's been, like I have been, through multiple cycles, and we're all sitting here feeling like, where are we in this cycle? How's it going to end? How do we compare this to other cycles? And that's why this is such a fascinating opportunity to have this fireside chat. So, Scott, I know people are not that interested in the office side of the sector, but I want to talk a little bit about New York City, about the office side of the sector, and then transition to multifamily. But you're navigating through probably the toughest period of time in that asset class, and give us, I don't want to spend too much time, but give me a little perspective and the group a little perspective in terms of, is there light at the end of the tunnel? How have interest rates and this economy made things even that much more difficult than they were?
Thanks, and Ivan, it's good to be here, and thank you for inviting me. And the story, just it shows you the date, how far back this went with Ivan. I remember trying to close the deal. I was on a payphone, if those who knows what that is, a payphone in San Francisco, where I finally got Ivan to agree to that lease. So you always have those memories in life. Before I jump into this, I want to just address one thing, which is Israel. I had the opportunity yesterday to spend a good part of the day with the former Prime Minister, Bennett Naftali, and hear what's happening on the ground in Israel, and the horrific events that occurred, the response that's occurring. But what the takeaway that I got from that, and I think it's important, particularly at times like this, because it really puts things into perspective, right, in terms of where we talk about the industry and work and all, sort of irrelevant in the context when you're talking about the life of your family, the future of your nation, but the resiliency of the people of Israel and how they have lived through this horrific experience, and it's become a unifying moment for them as a country that was very much divided, and their democracy sort of spiraling out of control, to listen to how he would describe it. And then the other thing is how hopeful he is and the people of Israel are, that they look at this as a wake-up call, and with great confidence and conviction that they're going to be successful overcoming the current challenge, but that this is going to springboard the state of Israel to a greater level of geopolitical relationships, peace, and prosperity. And so it's it was eye-opening to me, because I expected to hear all the graphic and all the horror stories that I heard, but I didn't expect to walk away with such a level of a sense of hope and a sense of conviction and not wanting people to feel sorry for them, but because they're on this, they're going to do this, and they're going to overcome it. So it was important for us as a country, because we ourselves have a period over the last number of years gotten more and more divisive, right? And we find misinformation, and there's this virus of hatred and anti-Semitism that's spreading throughout our college campuses and around the country. But unifying and standing up to hate, to racism, to anti-Semitism, this is what's key to make countries come together, people come together, and prosperity. And hopefully we don't need to have a horrifying event like what happened in Israel to be a wake-up call for us as a community. And I hope that we all focus on being ourselves, whatever we can do as leaders to set that tone, right? To have those conversations, to provide that level of support. And this is to me more important than any business deal or any economic cycle in the mixing. So I just wanted to just open with that. So now to the more mundane things of New York real estate, which is, what's happening in New York, but I would say it's not just going to be what's happening in the office market, right? I think it's happening across the country. But New York's dealing with both a structural office is dealing with the structural issue as well as a cyclical issue, and this whole change in this interest rate regime that we're seeing. And to your point of the early 90s, this is very much like the early 90s, right? This is not like '08, where we had a period of time where people were really speculative, and then we had some financial institutions in concentrated areas blow up, and then you could inject liquidity into the market and everything's going to be okay again. This is a regime change, and when Ivan was talking about that period in the early 90s, it was very similar in the sense that real estate values were inflated, not because of near or zero interest rates, but because of tax policy that was in place that incentivized people to invest in real estate for tax purposes. So it distorted the values and artificially inflated the values of real estate. 1986, the tax laws changed. By 1990, everything that was bought in that old regime had to be revalued, recapitalized, and re-equitized into the early 90s. And that is a multi-year process because you have to wait for each loan to mature that had a value that was there, and they have to get through the resetting of that. And so I would say as an industry, we're in like the first inning of what's going to be a long game here that's going to take us a number of years to work our way through to re-equitize that. And the office side in New York, you're also dealing with the sort of structural change coming out of COVID, which has impacted the way that people work. It's also impacted the way that people live and how they work and where they want to work. I'm not a believer that hybrid work is going to be the downfall of office. I think hybrid work is here to stay, but I think it's 3 or 4 days a week and flexibility. I think it's a good thing in terms of the life-work balance and the way that people do things. But 3 or 4 days a week, people need the same amount of office space. I think it's the type of office space. I think people don't want to go to buildings that are more dark and tired and aren't engaging. And the analogy I frequently turn to is what happened in the mall space. And if you remember when e-commerce happened, no one was going to go to malls. Malls were dead. If you could buy it online, who cares to go to a mall? All mall values went down. Tenants, didn't want to be there. Investors didn't want to be there. And then ultimately, the good malls that were well located, that had good managers, reinvented themselves as destinations. People would go there because they wanted an outing, they wanted engagement, they wanted to go spend the day. And there was a differentiation. It took a good 5 years of a Class A mall that was going to be a survivor and a Class B mall that was competitively obsolete. And even those Class B malls, frankly, there's still a lot of them around, and we've bought some ourselves that are now being converted because it takes a long time to get through that. That's the same thing that's going to happen to office space, right? Is that the buildings that can reimagine themselves as magnetic destinations that people feel good about leaving their homes. It's easy to get to. There are neighborhoods that have energy. They have amenities. They have places for people to collaborate. The infrastructure, light, air, they're going to do well. And we already see that in ourselves in our own portfolio. The winners and losers. We ran a program called the Project Kodak beginning of this year actually, where we went through every one of our buildings. We said, okay, like Kodak, there's going to be some of this stuff that's film. We shouldn't be investing in film because film is not going to be around long. But what's the digital? Which are the buildings that are digital? And we went out and put together a really objective set of criteria and weightings and weighted every one of our buildings. And fortunately, we're in a situation that every building stands alone, has no recourse, and so we're not going to put good money after bad in buildings that are film. And then in the digital buildings, we purposely didn't include the capital structure. We said, let's look at it. It's the building's competitiveness, irrespective of the capital structure, with the view that if the building was a digital building, we'll then go seek to renegotiate the capital structure, right? We'll then work on repaying that loan and having some loan forgiveness, whatever it is, if it can get done. And so we've done that for our buildings. Now we've done that for most of the buildings in Manhattan right now. And if you think about this market, it's sort of a trifurcation. It's the brand new buildings, which are getting $150 to $200 plus a foot in rent. There's the Class B buildings, which you really can't rent. In most cases, you can't give it away. And then there's everything in between, which is the Class A market. The sort of the digital spot that we are focused on is that top 25% of that Class A market. And when you talk to our traditional investors, it's toxic. No one wants to hear about an office building, right? They don't want to go to their investment committee with an office building. They don't want to go. Lenders don't want to go to a credit committee with an office building. So we've gone to non-traditional investors, high net worth, large family offices, special situations groups, and we've just closed a $500 million office recovery vehicle that we're going to bring to $1 billion. We last month bought 3 million square feet of interest in what I'll call digital Class A office buildings that we're now in the process of negotiating with those lenders to reset those capital stacks through that process. So it's an opportunity, right? You got to be contrarian. It's a stock picking game. You got to pick which buildings are going to be successful. You got to know where that tenant activity is, and you got to be, prepared that rents are it's not bouncing back quickly along the way. But it's going to, New York is a magnet. We've signed 1 million square feet of leases in the last 2 months, so people are transacting. It's just that the economics are challenging based on the basis that has been set. So you got to reset the basis, which is what we're in the process of doing.
So despite the struggles on the office side and despite the perception of how difficult things are on the office side, I want to transition to the multifamily side, which is what everybody here traffics in. New York City, from a multifamily side, I'm going to use your analysis of the digital analysis. Market rate, condominiums, residential, I mean, they're as good as they've ever been. Rent controlled, rent stabilized, of course, we all know about that. How in the world is the rental market and the condominium market so strong in New York City and so vibrant? And I always would say on the condo side, every high is followed by another high. I mean, the prices are just so high. What makes the residential market in New York so strong when the perception is so weak on the office side?
Yeah, but, which makes New York and all great cities successful, right, is the talent. People want to be there, right? And New York City is a magnet for talent. The best and brightest people from around the world, they want to locate there. They like the energy, the culture, the diversity. It is a place that people want to be. And actually, during the heat of COVID in 2020 and the beginning of 21, as people were fleeing New York on the multifamily side, we bought $2 billion of multifamily buildings when they were 80% occupied. Now they're 99% occupied. Rents are much higher. Buildings that we underwrote thinking we were going to get $70 a foot in rent on the residential side, we're getting $100 a foot in Brooklyn, right? Things you can't imagine in that context. So there, as a market for multifamily, I think it's like a 2% vacancy rate in New York right now. But the talent has come back, right? If you walk the streets of New York, you try to get into the restaurants, they're there, they're living there. I don't know, frankly, where they get the money to pay the rents that we're getting, but that's what this is. It's about talent, and New York continues to be that way. Now, I will say that there has been a changing paradigm, which you know well, which is that companies have recognized that talent is also distributed to other parts of the country. And so where historically, many of the big firms would say, I got to locate in New York or I got to locate in San Francisco, now they're willing to look around the country to say, where are there other pockets that are magnets for talent? And as we've expanded our business outside of New York, we've been trying to focus on those other, what I'll call superstar cities that have that level of talent migration flows. And we sort of characterize, we call EDs, MEDs, and well-leds. Places that have good education systems, good healthcare systems, which is usually a proxy for talent, and then most importantly, good leadership that's investing in quality of life, cost of living, economic opportunity, infrastructure, so that you're going to be able to continue to see people flow in to those areas. And it can't just be the city center, because for a superstar city to survive, and you're seeing this now in Miami even, right? It becomes so costly that the workforce can't afford to live there anymore. So you need to really have a superstar region, and that's the infrastructure part. You need to not only have the city center, but you need to have connectivity that people can find good qualities of life at a more affordable price that have close connectivity back to that city center. And so, if you think in New York City, Manhattan, New York City is 8 million people. If you think about just Grand Central and Penn Station, who can get there in 45 minutes, it's 20 million people, right? So as we look around today, you think about Phoenix and Dallas and Denver and Tampa and Raleigh, North Carolina, these are the types of markets that we're investing in because they have the same attributes that New York has, in the sense that it is a magnet for talent. But New York's still unique in the sense of scale. There's nothing like it in terms of scale. Google, when they mandated that their employees come back at least 3 days a week, they gave people a choice as to where to locate. So you could locate in California, you could locate in Virginia, you could locate in New York. 80% said they wanted to be in New York, right? So it shows you the power of what New York City is all about.
Before we talk about the fundamentals of multifamily and the resiliency of that asset class, everybody's dying to hear, with your purview on the Federal Reserve, your outlook of interest rates, the economy, how things went from a low interest rate environment that everybody thought would never change to inflation, which they thought was transitory, to now runaway inflation, to interest rates being at these astronomical levels, and where are we in the cycle? So how does it work at the Federal Reserve? How do they start to develop their policies? How do we know where we are in the cycle from an interest rate perspective? Can you give us some insight into how that works?
Yeah, so, first, we're living through a period that we haven't lived through before, right? Coming out of COVID, there were so many, infusions of liquidity into the economy, supply chain issues, change in behaviors about people not shopping because they're staying home, to all of a sudden shopping because they want to buy goods, to all of a sudden they're desperate for experiences and they're going out. So these are patterns that, if you look at the playbooks of the past and through the rearview mirror of what the Federal Reserve could look at, they don't have the data to really be able to extrapolate clearly what is going to happen. What they do know and what they fear, right, is that runaway inflation is, when it picks up steam, it's almost impossible to stop, right? And what they fear is what happened in the 70s. And as they say, they don't want to be Burns, who was the head of the Fed before Volcker. They want to be Volcker, right? And so, Jerome Powell, at this stage, after going through this transitory period and realizing that was wrong, and even communicating, I think, as late as 2021 at Jackson Hole, that you should expect interest rates to be low for longer, was the expectation, right? So 15 years after that, even in 2021, it was low for longer, right? And now they realized that's off. And so, we saw a historic increase in interest rates that at a level that we haven't seen now in 22 years, but the rate is a level we've never seen in terms of how fast the interest rates went up. And so when that happens, something breaks, right? There's financial shocks. We saw some financial shocks in March with the regional banks, but there's more that's going to come, because you can't raise rates as quickly as they did and not expect there to be financial shocks. And some of that's on purpose, right? The Fed wants the economy to slow down. And so, when just even this past week, right, the rally in the 10-year Treasury and has now taken a tool that the Fed was giving them comfort. If you listen to what Jerome Powell said, was giving them comfort because it was slowing down economic growth. It was tightening monetary policy when you had the 10-year at around 5%. Now it's down to 4.5%, right? And the stock market rallies up. That's counter to what the Fed wants, right? When that happens, it loosens monetary policy. It incentivizes them to either raise rates or hold longer because it's going the other way. It's interesting, just as a way of background, the way it works on the regional Feds. We meet every 2 weeks, and every 2 weeks you sit down with the board members and you get briefings from the economists and the market specialists and the president, and then each board member goes around and gives their view as to what they're seeing in the economy, and then you then go around and vote on what you should do with the discount rate. And so it's an interesting world where every 2 weeks you're going through that tempo, because you change your own mentality, because you have to be prepared to sort of share insights around that table. And you're hearing insights on my boards with the CEO and chairman of IBM, NASDAQ, hospital systems. So you're hearing all these different views, and you almost get a pulse as to what's happening. And you get the same thing from the president and the staff. But what I will say is they are hell-bent on not lowering interest rates until there's not a flicker of a chance of inflation coming back. So even if you're in a situation, which we could see, where the headline inflation numbers drop below 2%, I don't think that means rates are going to come down. I think that because just we're seeing ourselves, right? And we're watching what's happening with the multifamily rents that which lag in the Fed numbers, which makes up 30-40% of CPI or PCE, Now they lagged up, now they're lagging down, so now they're starting to flow through the numbers. So the headline numbers have noise in it that or they're not going to believe until they're sure inflation is held down. This is Scott Rechler's opinion, not official Fed, but I'm just telling you what my view is of this situation. And I think that is as that happens, and I think that the market is underestimating the Fed's resolve to do this and their view of, at the very least, keeping rates higher for longer and maybe raising them again. Now, I think raising them again has been sort of pushed back, but if you start seeing the treasuries come back down, markets rally, transaction activity, that may come back again. And there's a number of Fed governors that have said they'd like to see that, that we shouldn't be done yet. So it's a tough time. The other thing I'll say is that this is not an evenly spread around the economy. We know that, right? We're in a real estate recession. There's a manufacturing recession. Anyone that is a small business today, that borrows off of lines of credit or credit cards have seen, rates now at 22% for a credit card, right? You've seen people that are in the lower income side of the segment. They didn't lock in and buy a home and lock in a mortgage at 2 to 4%, and now they can't afford a home and they're paying higher rents. Their auto loans are 16% today. You're seeing, the weakness in that market on, credit delinquencies on autos and credit cards. So I think that's a sign of what's to come. The bigger corporate borrowers locked in longer term duration, right? So if you look at the graph, and the Fed shows you its graph, and the same is true for homeowners, if you look at the weighted average rate of borrowing for corporate bonds or for even mortgages, 30-year mortgages, it hardly moves in terms of what's outstanding. Yet when you look at the new origination, it's like this, right? So eventually they're going to converge. And I think you'll start seeing corporates, just like real estate, starting to happen in the next year, because a lot of corporate bonds are starting to mature at rates that are much lower than are now going to need to be refinanced. So that's going to then dampen the economy. And so everyone says, this time's different. Every recession we've been through, this time's different until it's not different, right? We're 12 months into an inverted yield curve. Somewhere in the next 6 months, we're going to have a bigger economic downturn, and we're going to have more financial shocks. I don't know how many or when or where, but they're going to happen. So we got to be prepared for it and be, cognizant of it. And I'll just end with this last point on the regional banks, because it's important to us as in our industry. When we had the situation with Silicon Valley Bank and Signature Bank, and then obviously Credit Suisse, and the tone from the Fed's reaction was, okay, we need more regulation. We need to look more closely at those books. So they put more regulators in, right? And so now, if you're a bank and you're under more scrutiny in terms of your commercial real estate exposure, and what's the quality of that credit, and what's the rate versus if you had to mark that to today's rate, what would that be? And that's not only, by the way, the regulators, it's the rating agencies are focused on it. And now, because things are so transparent, shareholders and depositors are focused on it. So, there's 4,700 banks in this country. I was saying to Ivan earlier, I could see there being 500 to 1,000 less banks between now and 2 years from now. I'm not saying they're all going to fail, but I don't think they're going to survive independently without doing something strategic. And from a real estate standpoint, when they're told to reduce their real estate exposure and they can't get paid back on their existing loans, that means they're not going to be lending, right? And you're starting to see it flow through in the numbers, right? More and more banks are not lending, and it's going to be the more of the non-bank lenders having to step in to fill the hole.
Well, clearly the Fed was slow to react and slow to correct, and they work on lagging data. And my feeling is that they're going to hold us longer than they should. And the economy really has significant signs of slowing down. Historically, I've been very involved in the residential business. That's how I began my career. That's how you and I met. And we must realize that the residential business really leads about 20% of the economy. That's just the residential business. The residential business is dead. Anybody who's in the home's not selling their home. There are very few homes being sold. And every time a home's sold, there are about 20 industries that go off of that particular sale. So I think there's so much significant headwinds in the economy that we haven't seen yet that's going to come out. We all know within our industry, the investment sales, multifamily sales, office, that's dead. So I think about 25 to 30% of the economy is really, really slow, and all of that's going to come to fruition. And I think it's going to happen much quicker than what everybody's saying. You know, this is the first month where unemployment went up. I think it's going to go up, and I think things are going to happen. And how much stimulus is really, really making the economy still move from what's occurred over the last couple of years, and what's the Fed's view on that?
Say, when we came in here, he told me he was going to be the optimist today. If that was the optimistic side, I don't know what the hell it was.
I'm getting there.
I was like, holy cow.
They only want to hear, everybody wants to hear one thing. When are interest rates coming down?
Right.
That's all you care about, right? So I'm leading to that conclusion, just slowly.
No. I mean, I think, to your point, right, the economy is going to come down. But let's also not forget there's also quantitative tightening happening, right? I mean, the Fed has shrunk its balance sheet by $1 trillion in the past year. And that's probably equivalent to another 100 basis point increase in rate that's occurred too. So there are other factors that are out there. To your point, there are other factors also, like there was the student loan forgiveness that's now unwound, and now that, you know, we'll see what the implications that have. And then there's counter factors the other way, right? Which is there's the Inflation Reduction Act and what it sparked in terms of investing in clean energy and things of that nature. So there's, you know, reshoring manufacturing and logistics and the investments that are happening there. There's the digital transformation that everyone's going through, cybersecurity, AI. So there are countervailing elements here. And that's why I think what you got to be careful of right now is looking at averages, right? Averages disguise the reality that you care about, because the averages right now may show a very different story than the people on the ground or the people in our industry really are feeling, because there's some big macro things that can skew those averages. Like I just went through a bunch of them. And so you got to really try to get more micro and think through what's happening, you know, in specific segments of the industry, of the economy, and specific cohorts that are being impacted by the economy. And that's something that, you know, I've asked at the Federal Reserve frequently to do is don't just say wages are going up. Where are those wages going up? If you tell me wages are going up because it's a service sector and people in the hotel industry and the airports and the restaurants were earning $9 or $10 an hour and now they're earning 20, that's a good thing, not a bad thing. And it's not something that's going to happen every year. They're not going to go up another $20 every year. It was a reset of something that should have happened before that, right? So we got to look through those averages and try to really understand the nuances of what's happening in the economy. Now, I say that, but I agree with you, because of that nuance, it's going to go higher for longer for too long, right? And then the question is, how much damage does that do? I mean, I don't think, this is my own personal view, I don't think there's any meaningful reduction in rates on the Fed side in 2024. So we used to say when Ivan and I first met, you know, stay alive to 1995. It's now, I think, stay alive to 2025. And to quote Sam Zell, who I think coined that phrase. But I think that's the reality, and that's what I say with our team, is think in that context, right? And on the multifamily side, because this is what we said, this is what they traffic in, right? That was how you phrased it. On the multifamily side, you know, there is a double whammy here too, right? I mean, you had the most amount of transactions ever done in 2021 at a period where interest rates were low and perceived they were going to continue to be low. Cap rates were at historic lows. People expected rents to go up and interest rates to stay low. Now interest rates have gone up and rents have stayed low. And so that's a whole issue. You have 1 million units of multifamily coming on the market in this short period of time. That's going to be further weight on the issue. And you have the banks not wanting to lend into that. And so there's going to be significant dislocation in the multifamily space. Now, the good news on the multifamily space, I would say different than the office space, is when you get to the other side, there's been such a shortage of housing, and it's been exacerbated by the lack of construction that's happening now, is that you'll have a faster recovery on the other side of that, 2-3 years from now. But it's going to be a 2 or 3 year period, I think, where there's going to be a lot of pain that the sector is going to have to go through.
So Scott, we've come across your funds on the build to rent side, and you're extremely active on that side, and you're still active on buying. And you're talking a little bit about the fundamentals of multifamily. I'll give my own perspective. Multifamily is not office. Interest rates are our worst enemy. Fundamentally, we're seeing still very strong patterns. Of course, the new deliveries are in the Class A on the higher end of the market, which is, not the biggest part of the market. How do you view the fundamentals of the rental market, especially in light of the fact that homes aren't being acquired, people need to rent? Is there real depth to that even in the short term? We know what the long-term view is. What do you see in the short term?
Yeah, listen, I think, to your point, and I agree with everything you said, I think the fundamentals in the rental market are good. And I think, and that's why we're investing in a lot of multifamily, and think it's a great sector. And I like the higher end, because I think part of it is there's a change, as I said, how people work, there's a change how people live. I think renting as a renter by choice, and for convenience and for amenities and for flexibility, is something that now has taken on a life of its own. And there's a whole new level of products that have been built over the last decade and a half that didn't exist before, right? We're not talking garden apartments, we're talking empty nesters that sell their home and they want to rent someplace because they want to travel and they don't want to worry about things and they want to have flexibility and they don't want their capital, or young professionals that want to do that. So I think there's a whole cohort of renters that are out there that are going to continue to drive demand. Now, that being said, when you have excess supply and you have a weakening economy, it means you're not going to see rent growth like we've seen the last number of years, right? I mean, I think we've seen extraordinary rent growth in some of our projects in Phoenix and Tampa. We've seen 15-20% rent growth. I mean, doesn't make sense, right, to see that. I think you'll have a period of at least on an effective basis with concessions, rent declines, as you absorb the supply. But as I said before, I think the other side of that's great. Like, one area that we like a lot is construction financing, because you're building products that will be delivered on the other side of this, right? So you're sort of investing today at great terms, not a lot of competition, and yet you're delivering 2 years from today. So that's an area that we think is an exciting place to be investing, both on the build to rent side of the business, or the multifamily side of the business. And I think it's an exciting time for multifamily, right? Because it's just like office. It's about community building. It's about hospitality. It's much more creative than it had been historically.
Have you given any thought to the influx of the immigrants, the 6 million or 4 million or 8 million? Where are they going to live, and how are we going to house them, and are they going to go to work? Because that's a shadow part of the economy that we're first hearing about and seeing about, but that's a lot of people. Where do they go? Where do they live? Where do they work?
Yeah, it's a good question. So, we in New York, obviously, we've had to face this really for the first time, versus a lot of the border states have been facing this for years, right? So, but we've had now, I think, something like 130,000 migrants over the last year come into New York, be the bus there or finding their way there, and it is a crisis on infrastructure, right? Because New York also has this. You have a right to shelter law, so no one has the city has to find shelter for everyone. We have built the largest migrant shelter in the city, in Brooklyn, across from the Brooklyn Navy Yard, 4,600 people. 30 different languages are spoken there. People want to work, right? But right now they don't have a right to work. And so some work illegally, which is there, but they're here because they took this risk. This is the land of opportunity. They want the opportunity to work, and the longer they don't work, the more frustrated they become. The more frustrated they become, the more problems develop, right? So they got to solve that problem and get people into the workforce. Historically, I think you wonder, because we've always had migration, maybe not to the scale, where people went. And I think historically where they went is to their community's area, right? I mean, they either went to some part of Brooklyn, some part of this, wherever you came from, you had community, you had family that would sort of bring you in, help you get your feet in the ground, and eventually you found the home. Now, it's become this new infrastructure of social support that didn't exist before. So it's going to be more challenging, I think, to help these people move on independently, and it's going to require more government leadership to it. But again, we have had a period as a country where we've had a negative level of immigration, right? So we need people to work, right? That's one of the reasons our employment rate is so low. So we need migration in, right? Economies grow because you either have more productivity, right, which maybe things like AI will create, and more population growth. We're not giving birth to more babies, so the way we get more population growth is we let more people come into our country to do the jobs that need to get done. But we got to find an answer to that, and it's not an easy one in terms of how it's going to impact the housing market.
Well, if we can put the people to work, everybody who owns Class B and Class C will be pretty happy because you'll have a lot more occupants paying rent. So that's the silver lining if that occurs. One of the things we've experienced, which we were not aware of, and even in a lot of the red states, during COVID, there were so many subsidy programs in so many of these properties, and they went on for years. So there were many people who weren't paying rent, and all of a sudden those subsidy programs are coming to an end. It's creating a lot of economic vacancy because people can't pay their rent. And that's starting to bubble to the surface. So we think there's probably another 12 months of washing that through, which puts a little bit of a stress on the system and has been creating a lot of the issues. But getting back to fundamentals, what we've also seen, other than interest rates, there's a whole issue with insurance costs. And everybody wants a solution. Is there a solution to insurance costs on some of these properties? Is the federal government going to step in? Have you heard any discussions on those issues?
So, the insurance issue is a tough issue, right? And I mean, there's obviously some things like in places where there's extreme weather, like here or other parts around the country, that have their own nuances. But the bigger sort of structural issue is that there's a clog in the reinsurance market. And so there's only 2 or 3 reinsurers in the world. And if they're not buying some of this insurance from the insurance providers, then you don't have enough ability to provide insurance, right? It's just think about the resale market. So there has been discussion about trying to think about whether there's a way to create more liquidity in the reinsurance market, which is something I think that ultimately needs to get done. I mean, that's why you have to really differentiate between insurance challenges and rising prices because you're in a spot with extreme weather, understandable, higher risk, but it's happening across the board, right? We're all seeing 20, 30% increases in insurance, even if you're not in this place that's a higher risk today. So that's something that's got to get fixed. But I will say this, and I wanted to go back maybe to lending for a second because it ties to something you talked about, which is government intervention. There's the government has very little appetite to intervene, right? Because after the 08-09 situation, they look at it as a bailout. They don't want to bail out. They don't want to bail out real estate guys. They don't want to bail out banks or women. They don't want to bail out. And that's a challenge. And there's a lack of trust when we say we have a problem. That is it really a problem, or did we do something irresponsible and we're in trouble and that we're looking for an out, right? And I would say in this instance, different than 08 and 09, no one did anything wrong here, right? I mean, generally speaking, everyone here was a responsible lender and a responsible borrower. We were playing by the rules of the game. Interest rates were low. We were told they were going to stay low. They were low for 15 years. It wasn't like and people were borrowing 60, 65%, 70%, but not 85, 90% like they were during the 08, 09 period. And so, when I sit down with the policymakers, I always have to remind them that no one did anything wrong. This is a fundamental regime change that is causing this pain. And that to do nothing from a government standpoint is basically going to result in a bailout of a really bad situation because they have no choice because so many banks are going to fail. that they're going to have to clean up the mess. They're not going to have a choice but to clean up the mess. Or they can proactively take steps to address it. Now, the problem is government in general are very good at responding to a crisis, but they're not very good at proactively trying to prevent the crisis because there's too much political risk in doing that. You know, when I've met with the policymakers in Washington, you know, they've asked, well, what can you do? We don't want to do about what can you do. So I suggested two things on the lending side. One is put out guidance that for every loan originator, they can decipher and segregate and define legacy loans versus newly originated loans. So when you're looking at a bank's books or a lender's books, the regulators, the rating agencies, these are new loans as defined by federal regulations as new loans. So they're probably healthy because they were actually underwritten in today's environment, knowing today's interest rates, knowing the current economic situation. So that's pretty good. The legacy loans could be challenging. Now, if you make that differentiation, more lenders might lend because they need to actually get higher interest rates to pay higher deposits, and that might unclog the plumbing, and you can then start having new lenders come in to then help recapitalize old loans. The old loans will take losses, there'll be new equity brought in, and then we'll have a system that starts functioning. If that doesn't function quickly enough, the advantage of creating this new characterization of loans is then the federal government could put in a TALF program like they did in 2008 and a asset loan facility where they then say, if you are originating these new loans, you can borrow off of this facility, and they can then supercharge liquidity into the marketplace in a healthy way to again help lubricate this deleveraging process and reequitization process that needs to happen. And I think that is a potential way to do it because politically, they're not bailing out the old loans, right? If you have a bad loan, you take the loss, you pay the price, you deal with it. They're only supporting new loans and helping the market. So I think you have to think in the mentality and be realistic that we're not going to get bailouts, proactively, but maybe there are some policies where you can actually get people to realize, okay, this makes sense to help create more liquidity in the market.
So there's been a lot of talk around, even the federal government, around conversions of office to residential, and you being such a large holder, especially in New York City where there's a shortage of housing, how do you look at that?
Listen, it sounds like it always makes sense, right? You have too many old office buildings, you don't have enough housing, so you should find a way to make it work. The problem is when you get to the details, it doesn't make as much sense, right? That's the challenge, right? It's a much harder process. We looked at our whole portfolio and went through it, and we have 3 buildings out of our whole portfolio that could actually make that conversion work, right? Because you need a couple things. The first thing you need values to come down to almost land prices. So we're not there yet, it's starting for some of these buildings, but you really need people to capitulate on values to see that happen. The second thing is you need a physical structure that is conducive to this conversion, right? Deep floor plates don't work, but if you have narrow floor plates with a lot of windows, that can work. So we have a building, 61 Broadway. It's a C-shaped building. So the deepest part is 60 feet. It's got a entrance off of Broadway and Trinity Street, so 2 different entrances, 2 different elevator banks. So you can create a residential entrance, an office entrance. That works. But when you get these big boxy buildings and you're cutting in atriums and you're then building extra FAR, maybe it works, but the risk associated with that is really hard. And then the third thing is, even if all that works, you have to empty the building, right? You got to get rid of the tenants. And so what's the time to do that? And of course you also need regulatory support, right? You need to, now the good news is a lot of buildings in New York are already zoned that can go both ways in New York City, but a lot aren't. So it's going to be much more challenging. I think it's an important thing to do when you can do it. I think it needs government support in terms of streamlining regulation and tax incentives. And and if we don't do it, what we're going to find is, and this is everywhere around the country, not just New York, these CBDs are going to lose their vitality, right? Because if you're not, even if you're in a situation where you have hybrid work and office buildings are okay, transit systems, restaurants, local stores, they don't survive on 3 days a week. they need 5 days a week, which means you need live-work communities to come together. So you need people to live where they work. Like we saw in Lower Manhattan after 9/11. Right now, there's 3 times the amount of families living in Lower Manhattan. 60,000 people live there. There's schools, there's parks, there's restaurants. It's as bustling at night and the weekends as it is during the weekdays. That's what we need to do across the country. If you put regulation in place and incentives in place, maybe it's a 5 or 10-year process to get there. If you don't, it's a 10 to 20-year process. And unfortunately, the longer you go, the more economic scarring occurs that has to be dealt with on the other side of that.
So in terms of where we are in the cycle, I think about 2 years ago, I think we had Barry Sternlick here, and last year we had kind of a discussion on, workouts and how to deal with difficult issues. And about 2 years ago, I was talking about 3 3/4 caps, and that's pretty low cap, and everybody had the attitude that's the new interest rate environment. And that was a period of time when we as a firm were like, okay, we're lending at the tightest spreads, the highest advance rates, and it didn't feel right. So as Scott said, I'm actually the optimist here, and I'm extraordinarily bullish, because right now we're in the highest cap rate and the lowest advance rates, which is where I want to be. And I really believe, from a multifamily perspective, this is going to be the greatest 12 months that we've had in front of us. We lived through a period of time for 12 years. It was a 12-year run. Every time there was about to be a correction, something crazy happened and rates dropped. So, fundamentally, as we've spoken about, the multifamily fundamentals, other than insurance, are really strong, putting interest rates aside. Interest rates have been our enemy. When you were borrowing at 3.5% and 4%, everything was cool. You had positive cash flow, fundamentals were good. All of a sudden, your borrowing cost went up, 75, 100%. But I firmly believe, specifically as a lender, and I would also think about it as an owner, that the opportunities in front of us are phenomenal. It's, of course, to have the staying power. And I do see the fundamentals as being very strong. With interest rates higher, people are not buying homes, they're renting. I think the immigrant issue is going to translate into greater occupancy. There's going to be a slowing of construction, as all of you know and Scott mentioned. Being a construction lender is great right now because the banks are out of the business. And what we're doing is the deliveries are going to be 3-4 years from now. The absorption is going to happen over the next 12 to 18 months. So we all know the last 12 months have been very painful. The next 12 months, it's going to be a lot to manage, but I think the outlook is very bright. And I'd wager very clearly, I think we'll see a sub-4, 10% quicker than we see a 5.5, 10%. And when we're sitting here next year, my feeling is we're going to be sub-4 on the 10-year. That's my optimism. What's your outlook?
So I'm not as optimistic. I'm not as optimistic. I'm as optimistic as a lender but I don't see interest rates dropping that quickly. And again, if that is the case, it means we have a big economic problem, right? I think that's the issue. What I would say is, and you made this point within sort of your commentary without saying it, the reality is we lived in artificially low interest rates for the last 15 years. We're never going back to that, right? So now we got to figure out what is that new normal interest rate? And I personally think, frankly, when the Fed talks about a target of 2% inflation, I don't think that's realistic. I think inflation's probably closer to 3% because of all the things that we talked about that's happening in the economy right now. So if inflation's 3% naturally, I don't see you're going to see a sub-4 interest rate, next year at this time. I just don't see it, unless we have a big economic collapse, which I'm not sure we're going to have on a macro average basis, because I think there's other dynamics. We may feel it, some of us more than others, but I'm not sure the numbers are going to show that.
Okay. With that, why don't we open up to some questions from the audience? Anybody?
All right. You said you don't think you'll see a sub-4 treasury in that time period, but I feel like maybe you're not sure if we'll see it at all.
I mean, again, and I don't. We had periods like we've dropped below 4 not too long ago, right? I mean, so in the mix, so you'll have some movement, and we've seen a lot of volatility. But I think I'm saying more on a sustained basis for a period of time. And the reason I say this is, and I didn't get this, and this is my optimistic part, right? My optimistic part of this thing is, I do believe that when we get through this, cleansing of the underbrush of all this liquidity that was in the system, on the other side of that, we as a country have extraordinary growth potential ahead of us because of a lot of the things that we've been talking about: decarbonization, digital transformation, onshoring, in-migration that's going to come to our country. There's no country in the world that's as healthy when we get past this point than the United States. So I could see, almost like a post-World War II golden era where, where a lot of the innovations like AI and new scientific discoveries in healthcare, as all that stuff rolls out, it's going to increase our productivity, and I think we're going to see a period of above trend growth. Now, with a period of above trend growth, it also means that you could also have more inflation. Now, the offset of that is if productivity kicks in, and so as we go through this 2 years from now, I would say AI, as an example, can be something that can really generate more productivity if it's adopted in the right way, and so that could then tame some of that inflation. So I would say that I could see a period where we're going to settle to whatever that new normal is, and it may be sub 4. I just don't see it in the next year. How do interest rates and the election have an impact? It's a good question. It's hard to predict what that would be. I mean, depending on who the candidates are and what their policies are. I think we know sort of what the Biden administration policy is. I think on the Republican side, it's unclear yet what their policy is. I do think, again, another point on interest rates generally is, and we should talk about this because it's an important point. The 10-year has structural issues right now, right? I mean, we have such fiscal deficits in the U.S. right now that we have an incredible amount of supply of treasuries that need to be sold, and they need to be sold into a market where our traditional buyers are moving out of the market, right? So historically, the Chinese, the Japanese, they were big buyers. The banks were big buyers. The banks aren't in the market anymore because they have to take charges against it. The Japanese, the Chinese, other geopolitical issues are pushing other countries away. So that net buyer is starting to dissipate. So the buyers are more hedge funds, institutions, which are now more price sensitive also, right? They're not just doing this for safety, they're doing it for returns. And so we may have some structural issues on interest rates, and on the election side, if someone is a deficit hawk, right, and saying we got to reduce that down, that's going to have some implications on interest rates, probably more for the positive over time. And if someone's, we're going to ignore it and continue to spend, that will have a negative impact on interest rates.
You mentioned at the beginning of your talk about, thank God, well, each building is own, a separate entity, and thank God no recourse, et cetera. But I was curious, how socially, business-wise, socially acceptable is it to either hand in keys, or how amenable are the lenders to reduce, reset the debt structure, the equity structure? It's great if it works out, but are lenders willing to play ball, and what kind of percentage are we talking about, and how a guy, obviously a business like RXR, it's so successful, you'll move on and lenders are always going to do business with you. But with the smaller borrowers, how will that affect their viability going forward to get credit?
Yeah. So I think it's when you talk about socially acceptable, right? Like everything's socially acceptable. It's as much the delivery and approach as it is the ask, right? I mean, if you're, our approach is constructive conversation, commercial, right? Here's where the value is today. It's not just we're asking you to do something, we're prepared to give something, right? So if we're going to go in and ask for a loan reduction, which we've been successful doing, we're either going to pay you off and give you liquidity, and if you're a bank, you want liquidity because you're being told to get paid off, so they'll take a discount for that, or we'll pay down the loan by a certain amount, and then let's reset it to a 65% loan to today's value, and you now have a non-performing loan turns into a performing loan, which is something that they take. And then if that doesn't work, then the concept is you got to be constructive to say, okay, I'll help you optimize your value, and I'll make this as easy as possible for you and for the asset, right? So I think it's the approach is important, right? And you got to be very, you have to approach it, to be constructive and focused on the relationship, but face the reality. They know the reality. Some lenders are going to say, I'll take it back, I'm equipped to do it. I think it's going to depend on the asset class. Multifamily, maybe they will because there's a market. Some will say, let's just short sell it. And if they can do it, they'll short sell it and they'll take what they get. And so you got to cooperate, but you got to be prepared, as a negotiation, to be willing to just say, okay, we're done, right? And we're going to, make this easy on you, not something that's hard. Question in the back?
Yeah. Well, I have it.
You mentioned the last thing you said is that you see how you believe that it's not going to be a macro change or a downturn for the economy as a whole, per se, for specifics, like some of us in the room might be feeling. In the last few years, so many different industries have been hit in their own way, whatever specific responses they were to the issues that were going on at the time. They're already really, how does that trickle down, meaning some of the issues that we might be having here, how does that not trickle down and have like a much more macro effect as you were alluding to?
Yeah, so I think the question was, going back to my, just to make sure everyone hears it right, was that based on the fact that this is, what I said was not equally distributed, and I think you said some industries have been hit for so long, and how does not trickle down hit the economy? And I think the answer is it eventually will. And I think, Ivan gave a great comment about housing and how much the housing sector impacts, the overall economy and transactions, right? We're watching, look at all the big brokerage firms, CBRE, Cushman & Wakefield, their earnings, laying off people, all that's happening. The question is, what are some of the other counterbalancing factors that also impact the macro that might offset some of that and delay it? But I do believe we're going to see a true recession. I just don't know, how deep, and it probably is going to feel deeper for some industries and some segments of the economy and the population than it does for others. But it may not be deep enough on an average macro basis to warrant the Federal Reserve, coming in and starting to reduce rates this quickly. Yes.
Yeah, you eloquently mentioned the fact that there is 67 million migrants coming to the country in the past 2.5 years. And the option of that is, watching the report I saw this morning, having been in Israel during the war, many of these people are not vetted. And there's no doubt that there are sleeper Hezbollah, Hamas, Realty cells throughout the U.S. And it's just a matter of time, God forbid, I overwhelmed, that they strike and do something dramatic here. How do you formulate that into your calculus in terms of interest rates, economy, demand, etc.? And it's a contingency that nobody wants to talk about. Maybe it's a big white elephant in the room. And I think it's something that we can be very cognizant of. It's just a matter of time.
Yeah, no, listen, being a New Yorker who, watched the first plane fly into the World Trade Center and down there and watches the buildings collapse, and now vice chair of the 9/11 Memorial Museum, I think about that a lot, right? And we've seen that, and I think even having the conversations yesterday with the former Prime Minister of Israel, and his talk about complacency, right? And that you can get complacent, particularly when you have a lot of internal infighting and distractions versus thinking about the bigger issues. I will say that in my time, when I served in different government positions and was able to be involved with the Joint Terrorist Task Force and the FBI, I mean, we have built a pretty extraordinary apparatus in the U.S. right now, and the amount of times that they've been able to, to get ahead of some of the potential incidents is pretty extraordinary. So I think we're in a different place than where we were. And I think when things like what happened in Israel, everyone raises their alert levels, their elevations, even we do in our buildings, and the security that's around New York. It's people are very focused on those types of things. But, this is where I think, to your point, it's the lone wolf is always the risk, right? It's not necessarily the operatives. And that's what you saw, what was so staggering about what happened in Israel, it wasn't a lone wolf, right? You always expect that, lone wolf, suicide bomber, no one can really stop that. That's hard to stop. But when you have something as organized as what happened on October 7th, is scary. In the U.S., we can clearly have lone wolves, and we've seen it with these mass shootings that have happened around the country that are horrifying, and we become almost numb to because it's happening so frequently. But if something big happens, I think as I always say, you got to recalibrate reality. All bets are off. Start over again, right? I mean, this is one of the big things we do at our firm. Is we start every year writing our view on the world, and develop a strategy around that, and then we're regularly looking at that to say, this is what we thought was going to happen. Is it happening? And when you have the discipline to write something down, geopolitical, economic, markets, it forces you to really be, thoughtful, but also you can't let your mind change. Your mind sometimes sort of bends, so you go back and read it. You think this is going to happen. If it's not happening, you got to adjust. So things might happen, and that's why I said before, things may happen here that then all bets are off. That we got to take a step back and figure out how you adjust to it.
So I want to kind of close where Scott opened, and that's on Israel. And Scott, one of the things you've mentioned, which I think is the most important thing that's being accomplished right now, is Jewish unity. And it really, from my perspective, is what is a positive or a silver lining. And I think it's the first time that the Jewish community, every single individual is doing what they can. Most of the time, people say, oh, there's nothing I can do that makes a difference, but it's different. Everybody is doing something, and collectively, it's exponential, and it's our force field. And I think that's the strong message, is everybody should do what they can. Scott's in a very unique position because of his political work, his connections with congressmen, senators, the president, and he's doing what he can. And all I urge is for all of us to be positive and do what we can. And that's 100%. It's a lot different than our messages on interest rates. That's where our focus should be. I actually think I'm right and he's wrong. But the way he opened and the way we closed, we have to understand that we have a great opportunity to create Jewish unity amongst our people and create a great result. So Scott, thank you for coming, and appreciate it.
Awesome.